Manpreet Gill, head of FICC strategy with Standard Chartered. He joins us live from Singapore. Manpreet, good morning and thank you for joining us. Are you a bit surprised with the kind of commentary we've got from US Fed? The minutes of the Fed meeting are not sounding optimistic, but they are sounding extremely bullish.
No, we're not surprised at all. I mean, it fits very well with our view that, developed market equities, particularly the US, are likely to be, the best performing assets this year as well. And if you think about the Fed stance itself, the very fact that they commenced tapering, earlier than market consensus expectations by itself was a great signal that, they were fairly confident in their outlook for the US economy. And the economic data we received the last 2 weeks of December, if anything, supports that fact. And if you look at indicators like your NEHP house price index, you're looking at durable goods, ISM manufacturing, I mean, everything we saw from about 15 December onwards was very, very strong. So, it matches with our view. It clearly fits with the recent economic data. And I think the minutes really sort of back up what we saw in terms of actual action from the Fed. So all in, really quite a consistent picture in our view.
Manpreet, hi, morning. What's the view on the dollar? Because the dollar index is already hitting at a 7-week high, and that is partly the reason why Asian equities are a little somber this morning.
I mean, our view for the dollar is one of gradual but multi-year strength. We've seen some of that, of course, occur. Like you said, we're at a 7-week high, so it's possible that given the kind of strength we saw the last 2 to 3 weeks, we may see in the short term a bit of, the currency take a bit of a pause. But when you sort of put the currency against the fundamentals, it's hard to see why the dollar should not strengthen. I mean, ultimately, you're looking at interest rates continuing to rise, so the yield attractiveness ultimately is improving from the levels where we are today. The external balances of the US are improving. We had the trade deficit which narrowed, and if you look at both the fiscal and the current account deficit in the US over a long period of time, I mean, they're showing clear and strong signs of improvement, and the economic growth picture is beginning to improve. I mean, these are all ultimately very, strongly supportive factors for the dollar. So we're not expecting dollar strength to be dramatic, but we do expect it is likely to extend as the Fed pulls back on its liquidity injections and as, economic growth continues to improve.
Manpreet, so do you expect that the quantum of taper could increase? For the moment it is 5. Do you think 5 could become 10 and 10 could become 20 soon?
I mean, it's possible, but it's not something we're really taking a strong view on. I mean, to us, the Fed has already started on the path of tapering. And given that they've started, it's very hard for them to say that, we're going to pause or potentially cut back on it. Increasing the pace, yes, it's possible, but in our view, the market has already moved beyond this point. And by the time we reach, the second quarter, it's very likely, the conversation will already shift to what after tapering. So in that sense, whether tapering ends a little faster or a little slower than what the current pace allows for, to us will not have a tremendous impact on markets. To us, it's really about what the market moves to price in terms of when the first actual rate hike might occur. In our view, that will be well into 2015, not sooner than that. But of course, market expectation could vary, and to us, that will be the key question in 2014.
Manpreet, what's the sense that you're getting about India? While the markets have been somewhat weak and lackluster yesterday when it comes to the frontline indices, it is the FIIs which have slowly been easing out the past 3 days. What's the big concern when it comes to India?
Well, with India, the concern is not any different to what it was a few months ago. I mean, in India, there are two primary concerns for foreign investors at the moment. One is the fundamentals themselves, that if emerging markets more broadly, begin to sell off, not due to risks in India, but due to risks anywhere else, investors are still concerned that India may be affected. I mean, partly because, a country still runs a current account deficit, even if it temporarily reduced at the latest reading. But the second is that the political cycle does make it fairly difficult to invest. I mean, market behavior over the past few months has made it fairly clear that they're looking at elections in a fairly binary way, where, if we have a strong single government that's, capable of making strong decisions, they're, treating that as a positive outcome, while, a fractious coalition would, of course, be negative. And that makes it, very difficult to predict the market outcome. It makes it a very difficult investing environment. So we believe that's also clearly a concern. It's a concern for us, so we're really taking more of a neutral stance until the risk reward ultimately improves and things become clearer.
Manpreet, do you think somewhere global equities are pricing in all the good news? Because Dow is now at 16,500, Nasdaq above 4,000, Indian markets not very far away from a new high, and that seems to be the story with all emerging markets with the exception of China.
No, we do not believe that markets are pricing in the good news, but the story does vary market to market. The one point I really want to emphasize on is that, I know that nominal indices, the numbers we look at, are at, record highs, but the fact is that when you step sort of one level below that to the valuations, we are far away from, the historical range highs as far as valuations go. If you look at the US and Europe, for example, we're barely beginning to approach long-term historical average levels for most valuation measures, regardless of whether you're looking at PE, PB, equity risk premium. So valuations are not likely by themselves, are unlikely to hold markets back. To us, it's much more about, will they actually take a pause at fair value, or will they continue to overshoot fair value as they always have done in the past? And to us, as long as the economic momentum, as long as the earnings momentum continues to remain positive, we just believe that an overshoot on the positive side is much more likely in the US and Europe, simply because valuations aren't anywhere close to, even recent range highs.
Manpreet, that's a fair point, but last time when US economy or US markets were trading at a P multiple of 15 times plus, the growth dynamics were completely different. What we've seen in 2013 is a big P expansion which has not been backed by earning expansion. So for the moment, some would argue that, look, market is going up only because of hope and hype.
Agreed. And one of the points we made in our annual outlook is that markets have moved ahead to price a more optimistic outcome. Now it's time for the economy and earnings to deliver. So yes, I agree with you. That's clearly a risk that, look, if the earnings side does not deliver, equity markets could be in for some trouble. But the fact is that, market multiples expanding, markets moving to price in a more optimistic outcome before the fact is not unusual. That's how markets have behaved in any recovery, especially off, the low P levels that, US equities started off, for example. So the behavior till now is not unusual. And in any normal recovery, earnings and economic growth do begin to catch up. Our base case is that if you look at the recent economic data, the economy and earnings should deliver. And that's why we're still comfortable with that outlook. But yes, agreed with you. We are watching earnings much, much more closely than we were last year, simply because it's now become much more important that those earnings actually do deliver.
Manpreet, good chatting with you. Really appreciate you taking the time out and speaking with us today.